episode number 6. Hello, friends. This is the Expected Returns podcast. My name is Stephen Lutman. I'm a real estate investor and broker in the capital region of New York State. If this happens to be your first time checking out the show, welcome. Topics here center around real estate. However, we'll also touch on financial markets and any macroeconomic data that affects housing. If there are ideas or concepts you'd like discussed on the show, don't be shy. Email Stephen at sjlincoln.com or DM on Instagram, sjlincolnrealty, and it can be either a conversation for the show or just a secret between you and me. But either way, certainly reach out. Happy to connect. And if you've ever thought to yourself, I wonder what Steve actually looks like, well, prepare to be disappointed because the YouTube version of this show now includes actual video. I plan on putting out a bunch of video content this year, so subscribe now to make sure you don't miss anything. The channel at the moment is pretty small, but once you're on the platform, search for SJ Lincoln Realty, and eventually you'll stumble across it. But yeah, stay tuned, and hopefully more content to follow. Quick plug, the newsletter went out to subscribers within the past 24 hours or so. Be sure to sign up at sjlincoln.com/join. It's free. I should be charging you, so hurry up before I change my mind. But if you want to just give it a glance without the commitment, sjlincoln.com/newsletter. Now let's get to the show. One of my pet peeves, I can't tell you the number of times I'll turn on the news or some form of a podcast. They'll be covering a story, maybe a correspondent or some type of special contributor will join, someone who's an expert in a topic, and they immediately start using big words and abbreviations, and I'm instantly lost. Now, these people might have all of the answers, but it really doesn't matter because they're not presenting the information in a way for the general public to really get anything from it. I never, ever want this show to be like that. This is geared very much as for the people, not for professionals. Now, that's not to say we won't ever try to tackle some complex concepts, but the goal is to do so in a way where you can then take the information we discuss and explain it to a friend. So, with that said, I thought it would be helpful to run through some common phrases and abbreviations you might run into if you have a real estate related need or maybe just finance in general. But we often discuss here the importance of having your financing lined up prior to home shopping. So preapproval and prequalification frequently get used, sometimes interchangeably, but are they the same thing? They're not. So a prequalification you can think of as something that's non-binding, and it's more so just an estimate based on, and here's the important part, information provided by the borrower, so you, to the lender. So you walk into the bank and say, hey, Mr. and Mrs. Lender, I make $5,000 a month. I have a car loan that's $300 and student loans of $200. Tell me how much of a mortgage I could qualify for. A pre-approval, on the other hand, is going to be, we'll say, a little more intrusive. You're going to be asked to provide pay stubs, tax returns, consent to having your credit pulled. Which one should you do? Almost always the answer is go ahead and get the pre-approval. It's significant, certainly for your own peace of mind, so you have something concrete from your lender that says, okay, given no economic situations within my own personal finances change, I should be able to close on a loan for X amount. But more important than that, it's going to prove to your agent that you're going to be working with that they should be taking you seriously. They can say, okay, this person has taken the time to connect with the lender. They've demonstrated an ability to potentially close on X amount. Great, perfect. But even more important than that, so more important than your own peace of mind, more important than making your agent feel confident is that the seller of the property that you're ultimately going to be submitting an offer on feels confident that you can actually close on a sale to purchase their house. That's the most important reason why you get a pre-approval. Now, if you've listened to episodes 1 through 5, you know pretty much every single episode we stress how important it is to have your financing lined up. And it's essentially table stakes today, given how competitive the housing market is, that if you're going to be submitting an offer, you really shouldn't be doing that without a pre-approval with it. So that's why you want to get that done. Now, is there ever a time where a pre-qualification is more appropriate? The only time I can really ever think of is if you're really early stages to home shopping, the process is completely new to you. Maybe you've never gone out and gotten a loan before, you just don't know how the qualification process works. I think it would be a good learning experience for you just to get on the phone, have a quick call with a lender. Key points here is it's not binding, so you aren't committed to work with that lender going forward. It's free. You shouldn't be paying anything for this. There shouldn't be any type of a hard credit pull with this. So every time someone pulls your credit, it does get dinged a little bit temporarily. But with a pre-qualification, they shouldn't be pulling credit, so that shouldn't be a concern. So again, free, no credit pull, not binding, really no downside, just a learning experience for you. But if you're actively touring properties, if you're ready to pull the trigger, go get the pre-approval. Next, let's talk about APR versus APY. So annual percentage rate and annual percentage yield. Now, this is strictly from a borrowing perspective. If you're depositing money at a bank, it's a bit different. But when you're obtaining a mortgage and you call your bank and the loan originator says they can do 3.75% APY and 3.8% APR, well, wait, which one am I getting? Why are there two different rates? The interest rate you're paying is the APY, the annual percentage yield. The APR in our example was 5 basis points higher, so 3.75% versus 3.8%. And quick side tangent, so when we say basis points, it's just another way of talking about rates. So if something increases, let's say 100 basis points, that's just a full percent. So if something goes down 50 basis points, it's half of a percent lower. So the APR is the APY plus some of the nonsense that banks charge to facilitate the loan, things like origination fees or if you're buying points on the loan. But the moral of the story here is when you're shopping for a loan, make sure you're comparing apples to apples. So in this case, if you're getting quoted an APY at one place, make sure you're asking for the APY at another. We don't want to be comparing APR versus APY. So just keep that in mind. Next is loan to value, LTV, is the amount of equity, so your money, needed in relation to the lender's money. If a house appraises for $200,000 and your bank will agree to lend 90% loan to value, it just means that they're going to be dishing out $180,000 and you're on the hook for the remaining 10%, so $20,000. Another way of looking at it is you'll often hear people talk about FHA financing allowing for 3.5% down. The other way to phrase that is 96.5% loan to value. On that topic, let's go ahead and discuss FHA. So this is the Federal Housing Administration overseen by HUD. So we're talking about the federal government, Washington, D.C. Here's the misnomer. The government is not issuing these loans. Okay, this is not taxpayer money. What FHA does is outline specific criteria they want borrowers to meet. So this could be income, credit score, etc. It says to lenders, if you originate loans where the borrowers match the criteria we're looking for, we're going to go ahead and insure you against losses should this borrower down the road default on the loan. So stop making payments. Why does the federal government get involved in housing? Well, they would say that there needs to be a mechanism to help underserved communities get into the ranks of homeownership. Now, the spread between white and black homeownership today is something like 30%. So by essentially backstopping bank losses, it allows lenders to offer products with lower credit scores, lower down payment requirements, without the lenders taking on an inordinate amount of risk. What I would say is this is at least partially true. However, the other part of the equation is that the federal government is very, very greedy. Throughout American history, there really hasn't been a better vehicle for lower and middle income folks to generate wealth than by owning your own home. And the more wealthy you are, the more money you're going to spend. And the more money you're going to spend, the more you're going to get taxed. So high home ownership rates are great for the coffers of local municipalities. So yes, FHA does some wonderful things helping folks qualify for loans that traditionally would have been left behind, but I don't view it as strictly a philanthropic venture by the government. I think there's certainly some upside for them as well. Let's finish this segment with something we've been hearing a lot about recently, and that's inflation. And inflation is just a fancy way of saying, in terms of a percentage, how much more expensive is something today versus a previous point in time? So you hear on the news inflation up 7%. Well, what exactly went up 7%? Not everything went up exactly 7%. Used car prices are up 40% this year. Clothing 5%. What they're referring to is the CPI, the Consumer Price Index, and this is put out monthly by the Bureau of Labor Statistics. The CPI tracks a basket of common household goods, things that you and I are buying every single month, food, shelter, energy, and compares it to different points historically. It's worth noting that during times of high inflation, it's typical for wage growth to also be strong, which is actually something we're encountering today. We'll say increase in CPI is 7%, but salaries grew 4%. Well, the net effect of that inflation is really 3%. There's an argument amongst economists that the CPI isn't nuanced enough because changes within that basket that we discussed earlier don't impact all families the same way. And what I mean by that is, say, for example, apparel and recreation saw a 10% rise. Well, that's going to disproportionately impact middle and upper income families because they're more likely to spend on that particular segment of goods and services. On the flip side, when there are times of spikes in energy costs, that has an overweight impact on lower income households because more of their income pie, we'll say, is designated towards things like heating their home. So not all changes within the CPI are created equal. And going forward, when you hear inflation, think a basket of goods. If you happen to like that segment, let me know and potentially we'll bring it back for a future episode. A few items in the news, but first a quick word from today's show sponsor, S.J. Lincoln Realty, helping home buyers and sellers throughout the capital region, headquartered right in the village of Ballston Spa. I've been an investor for the better part of a decade and operate the office here as the licensed real estate broker. If you'd like to connect, my email address is steven@sjlincoln.com, or connect with us on social media, SJ Lincoln Realty, Twitter, Instagram, Facebook, or visit the website, sjlincoln.com/book-a-call. Again, you can email steven@sjlincoln.com, connect with us on social media, SJ Lincoln Realty, or visit sjlincoln.com/book-a-call. And now back to the show. Okay, so where I want to take the show next really shouldn't be any type of big surprise. It's all that anyone's talking about at the moment, and that's the Russian invasion of its southwestern neighbor, Ukraine. Now, to be clear, this conversation is going to be focused solely on understanding sanctions and their economic fallout, not the morality of war, not a deep dive into the history of the Soviet Union. There are plenty of folks out there more talented than myself to take on something like that. But when you live in a global economy, which we do, we are all connected, and that's whether you like it or not. So, first, we'll take a look at where we were before the conflict began. Russia is the world's 11th largest economy with a GDP of $1.5 trillion. And it's going to be just behind folks like South Korea and Canada, which I found a bit surprising. For reference, the US economy is roughly 15 times larger at $21 trillion. Daily international transactions, so these are going to be various countries buying and selling with Russia, last year was $46 billion daily, 80% of which being transacted in US dollars. So let's put a pin in that for the moment. The European Union relied on Russia for almost half of its gas last year and a quarter of its oil. That's where we started. Now let's fast forward to the end of February. War has broken out. Japan, US, EU are all interested in aiding Ukraine without directly getting pulled into the conflict. This is what gets us Executive Order 1424, levying economic sanctions upon Russia that is going to make their lives very unpleasant. So their two largest banks, VTB and Sberbank, are going to be blocked from conducting banking transactions that involve the US dollar. Now, there's a carve out for a time being for medical, farming, and energy, but for the time being, they are blocked from the US dollar. On top of that, 13 enterprises with ties to the Kremlin. So their economy is structured differently than here in the States, whereas we have something like ExxonMobil, if you will, right? That's a privately held company. They have their own oil producers in Russia, but they have direct ties to the government, not private. So 13 enterprises with ties to the Kremlin, unable to raise debt and equity. So that's essentially freezing their businesses. How is this possible? What are the physical mechanics behind blocking another country? This isn't like the federal government going after New York State, right? This is a completely different nation. How does that work? It all comes down to something called SWIFT, not Taylor. Maybe we need her, but it's the Society for Worldwide Interbank Telecommunications. If you write a check from, say, your Bank of America checking account to pay for an auto loan at Trustco Bank, nobody is physically carrying that $300 from B of A to Trustco. It's essentially just a click on the mouse between the two institutions. Without access to SWIFT, it's pretty easy to see how damaging that can be for an entire country's economy. Now let's jump ahead to where we are today. One American dollar can purchase 116 Russian rubles, whereas 4 weeks ago, it would only get you 75, meaning the ruble has lost about a third of its value in just 1 month. There's currently a run on banks where citizens in Russia are panic withdrawing their money because A, their bank could legitimately go out of business, and B, if this devaluation of the currency is going to continue, we need to figure out how to get this being rubles, how to get this exchanged into something that's more stable. But old Vlad Putin beat him to the punch because he put a kibosh on limiting withdrawals of foreign currency. So you can fairly easily get what you need in terms of rubles, but he's going to be locking down ATMs. And on top of that, they also bumped borrowing rates to 20%. Why does that matter? Why are they increasing mortgage rates? If your banks are limited on funds, you need to limit the amount of dollars that are going out the door. So when you bump interest rates, it's much less attractive for a borrower to say, boy, I'd really like to go build that addition to my factory. Let me go to the bank and get a loan if you're going to be paying 20% on that money. So that's what they're dealing with. In the past few days, Western nations have also agreed not to purchase Russian oil and gas, which accounts for 40% of their entire economy. So they have a massive problem on their hands. They've been locked out of the global financial system. Their currency is cratering, and nobody outside of maybe China wants to buy their greatest export. Not a fun time to be Vlad Putin. Some heavier topics on the show this week, so let's wrap up with something a little more lighthearted. There is a horse from New York named Un Ojo, and for my Spanish-speaking listeners, you know this translates to an eye, because after an accident as a 1-year-old, you guessed it, my man has one eye. And despite this, he's still out there running around doing his thing. On February 26th, entered something called the Rebel Stakes, which is a qualifier for the Kentucky Derby at odds of 75-1 because he has one eye. Let's take a listen to the call.
Barber Road is next to the outside, chasing time. It is Ethereal Road and Kavad coming to the wire. Ethereal Road has the lead. Kavad, Un Ojo to the inside. Ethereal Road, a final charge from Un Ojo.
So if you're having a bad day or think there's something out there that you want to do, but you just can't do it, think of Un Ojo. With one eye, will be running in the Kentucky Derby. So let's get after it. That's it for today. Thanks for listening as always. This is the part of the show where I now lean on you. If you found this valuable and have a real estate related need or know of someone who does, let's have a conversation. Steven@sjlincoln.com is the email. sjlincoln.com/book a call is the website. If that's just not doable, the next best thing you can do is send this episode to a friend or a family member, someone that you think might get something out of it. Steven@sjlincoln.com, sjlincoln.com/book a call. Thanks for the support. We'll talk again soon.